So the next one we're going to be talking about is risk per trade and position sizing. We already know that stop loss is a place where you believe you are wrong in the market. But this particular session of the course is very tricky and it's a little bit technical. And I hope you pay attention to this particular lesson. So what do we mean by risk per trade? Risk per trade is the percentage of total equity that a trader stands to lose per trade. So risk per trade is the percentage you are willing to lose on a trade, and this should be a fixed percentage. Do you understand? So let's say you have $100 and your risk per trade is 2%. So with that $100, you don't want to be losing more than $2 per trade. That would be your maximum risk per trade. So once you are wrong and you are losing up to $2, then you should close that trade. For you to liquidate an account of $100, you have to be wrong how many times? You have to be wrong 50 times for your money to finish in that particular account, which is unlikely to happen. You can't be wrong 50 times without being right once. Do you understand? So your risk per trade is the percentage you are willing to risk on a particular trade. Let's say I'm risking 2% of my account and I have $100 in my account, right? So I have $100 and I'm risking how much? I'm risking 2%, and 2% is $2, right? So every trade that I'm going to be taking, I must not lose more than 2% of my total capital, which is $100. So I must not lose more than $2. So that is risk per trade. That's what risk per trade means. So when they say what is your risk per trade, it can be 1%, it can be 2%, it can be 3%, right? For traders, I want you to take note of this. You must not lose, or you must not risk more than 5% of your account per trade. Please note that you must not risk more than 5% of your account per trade. So if you have $100, you must not lose more than $5 per trade. So risk per trade is the percentage of your total equity that you want to lose per trade, right? You must not lose more than 5% per trade. Please note that. So risk per trade is basically your total equity multiplied by your risk percentage. So if you have $10,000 and you are willing to risk 3% of that $10,000, so it means your risk per trade in dollar ratio is $300. If you are using $10,000 to trade right now, you must not lose more than $300 per trade. Do you understand? So that is how to calculate risk per trade. Is your total equity multiplied by your risk in percentage. So if you are risking 2% and you are trading with $10,000, you won't be losing more than $200 per trade. So what people get wrong is when you say risk per trade is 3%, for example, you have $10,000 and your risk per trade is 3%. Some people think is the 3% you are going to be spending on that particular trade, or the 3% you are going to be using to buy that particular coin. That is wrong. The right thing is, by the time you enter a trade with $10,000, what you are going to be risking is $300. It's not like you are using that $300 to buy that particular asset. That is wrong. So crucially, this does not mean a trader buys units worth $300. Risking $300 on a trade means that if the trader gets stopped out, he or she will lose $300. Please don't get it wrong. When you say you are risking 3% out of $10,000, it doesn't mean you are using 3% of your money to buy that particular asset. It means if you buy that particular asset for $10,000, if your trade goes wrong, you are only going to be losing $300. I hope you get that now. So for position sizing or position size is the number of units of an instrument a trader purchases. So let's say you have $100, right? Let's say you want to buy a coin and the coin is worth $1 per unit, right? So and you want to buy, let's say you want to buy 100. So you are going to be spending $100. So that $100 you are spending is your position size, right? You are buying 100 units of this particular coin for $100. So that is your position size. And you just don't pick your position size. I'm going to be showing you how to calculate position sizing later in this video. So you understand the concept of position size. It's just the amount of money you want to use to trade that particular coin or to trade that particular asset. That's your position size. So for position sizing, how do we calculate position sizing? Because for you to calculate your position sizing, you need your risk per trade and you need your stop loss placement, right? We've talked about stop loss, which is the invalidation level. We've talked about risk per trade. That's the percentage of the total equity a trader stands to lose per trade. Then we talked about position sizing, the number or the amount of money you want to put on a particular trade. So how do we calculate a position size? There are two key pieces of information a trader needs to calculate a position size. The first one is risk per trade. The second one is distance to stop loss from entry in percentage. To understand this better, let's move to our chart. So now I said the two key pieces of information you need is risk per trade and distance to your stop loss from your entry in percentage. Let's say this is an uptrend, right? And then you think from your analysis, you think the price will get here in the nearest future, right? You think the price will get to this region. Let me use a box. So you think the price will get to this region. So you are looking for a long trade because you think price is going to go up in the nearest future. So what happened was that you entered the trade when the first higher low formed. You know, when you start having higher low, it means there's an uptrend. So you entered the trade around, let's say around here, right? You're entering the trade around here, and this is your low, this is your support, right? This is your support, right? You're entering the trade here, and you have your support here. So at what point would you say you are wrong in this trade? This is our risk reward diagram. So now you are targeting 12%, but at what point will you say you are wrong in this trade? So we have a support. So we'll say we are wrong when price starts to break below support. So your stop loss should be just below this support level, because you expect this support level to hold if you're having an uptrend. So even if price comes down to this support level, it's supposed to bounce and go up. But when price starts to go below that support level, I will say I am wrong in this particular trade, right? Because once price starts to break below, we are no more forming higher lows. We will now be forming lower highs. I hope you understand that. So now this is how you calculate the position size. We said we need the risk per trade. We are risking 5% of our total balance per trade. So we are risking 5% of our total balance per trade. So let's say our total balance is $100, right? So in this trade, I must not lose more than $5, which is 5% of my account balance, which is $100. So now the distance between my entry, this is my entry, this is where I entered the trade. Let me pick it out. This is where I entered the trade. Let me change it to blue. This blue line is where you enter the market. So blue line is your entry price into the market. So you enter the trade around 10,966, right? And then your stop loss, you believe if price breaks below this support that we have here, then you are wrong about that trade. Your stop loss is 2.7% away from where you entered, right? So the distance between your entry price and your stop loss is 2.7% away. So now I want to take the trade. I've not entered yet. I want to take the trade. I already know my target, which is 12.8% away. And I already know my stop loss, which is 2.7% away. Now I want to calculate how much should I put on this trade with $100 account. So this is what I'm going to do. Remember, my risk per trade is 5% of $100, which is $5. So in this trade, I don't want to lose more than $5. So if I put $100 in this trade and the trade goes against me, by the time it hits my stop loss is just 2.7% away from my entry price, which means I'm going to be losing $2.7. But that's not the way it works in the market.